I'm Osborne Foreman, and in this week's video I'm going to show you the UK stock to buy for the 4th week of January 2021. And if you find the video useful or moderately entertaining at least, please drop one of these, support the channel. I'd just like to disclaim that this is a completely new series on the channel, and I've taken the idea from the portfolio update series and decided that I really wanted to add more time and value to this, so I figured that I could split it and create 2 separate series from it. So please be mindful that I haven't got a format for these videos yet, so it may be a bit scrambled, and hopefully that can be refined with more videos in the series. And if you have any suggestions or there's something you just didn't like about the video, please do leave a comment down below and we'll work through it. Lastly, this series may replace the monthly stocks to buy series, although I'm still very much undecided on the matter, and it truly depends on whether I'm able to find enough stocks, as I don't want to get overwhelmed trying to look for new stock opportunities if there just are none available and end up getting too stressed from it, for example. The same might apply, and this, whilst it is a stock to buy in the week, it doesn't necessarily mean that this will be a weekly series, and as I said, it really depends on what I can see in the markets. In the current market climate, I've been interested in stocks that would benefit from a surge of spending, as I believe with the UK economy and the current lockdown that we are in, I believe a lot of people, a lot of households have been saving money. This means that at the moment they're going to keep saving money. They're not spending as much because the high street's shut. They've got less things to spend their money on. Therefore, more households are going to have higher levels of saving. And I believe that once the lockdowns end and that we have the economy reopen and that consumers or households feel more comfortable, then that we're going to see a lot of spending, which is likely going to boost the short-term GDP of the UK. But the main part is that I would like to find a company that could benefit from this level of spending that perhaps isn't quite priced in. Although with that in mind, I'm not just interested in a company that will benefit just in the short term, but rather can use this short-term advantage to fuel their growth for the future or over the longer term. So I found a UK stock that is listed in the AIM markets. The ticker symbol is BOTB. BOTB is actually considered a small cap with their market capitalisation of around £260 million. However, I think small cap stocks are favourable. This is because it's much easier for them to generate a 10 times return on your investment. For example, just to go to 10 times your investment if you'd have bought shares in BOTB right now, it would have to be a £2.6 billion company, which I think is quite reasonable. Whereas a £3 billion company, for example, to become or get you 10 times return on your investments, they would have to become a £30 billion company, which I think is a lot more difficult to achieve, but not impossible by all means. Most likely meaning it will take longer for the latter to get you that 10 times return, whereas the smaller cap stocks, they have the potential to grow quite rapidly. Regardless, I think Best of the Best is well placed to benefit from the surge of spending. Although it's very likely that they have already benefited from this, but I would hope that this would be a continuing trend in the future. Although it is very likely that they've already benefited from the lockdowns and the pandemic, as it has been going on for nearly a year now, and this could mean that they are less valuable due to their valuations being higher. Best of the Best operates weekly competitions for luxury goods online, typically sports cars, as well as previously through retail sites like airports and shopping centres, although they have been transitioning this business model and have now completely transitioned it to being online only with their own apps as well. This means that in the future they could certainly scale out their operations and very likely maintain, if not grow upon, their high profit margins of 24.7%. Best of the Best had released their interim results for the 6 months up until October or late October in 2020, and what we could see is that in this time period their revenue had gone to £22 million compared to 2019's revenue for that half of only £7.6 million, which means they had pretty much tripled their revenue over this time period compared to this time last year. Whilst their cost of sales has also increased by nearly 3 times, it's not been as much of a multiple, meaning that as their revenue increases, the cost of sales is actually going to increase, but not as much, meaning the more revenue they make, the higher their profit margins can be, which is a great sign as they have scaling margins for the future. Yet with such incredible revenue growth and scaling profit margins, they are still valued on a price to earnings ratio of less than their industry and really not that much higher than the markets. And that suggests to me that with a valuation re-rate, there's a lot of potential for this stock to generate returns based on valuation multiples as well as earnings growth, meaning that it could be a good time to buy into best of the best. Although when we consider that the first 3 months of that financial half year of 2020, we were also in a lockdown, this could suggest that perhaps sports betting at the time was closed, which I would consider indirect or direct competition towards best of the best. And this would mean that that money that would be going to sports betting would have likely went towards their online competitions, for example, which could suggest that their revenue has been inflated, but we'll look more on that in a bit. When we look at best of the best balance sheet, we can see that it is of fantastic quality. This is because their short-term assets outweigh their short-term liabilities, and it outweighs their long-term liabilities because they have none. Furthermore, they have absolutely zero debt on the balance sheet. They have high levels of cash, and that cash position is £11 million or over £11 million, suggesting that should they for some unforeseeable reason become temporarily unprofitable, that they do have the cash on the balance sheet to be able to survive. But I think this is completely unlikely due to their online only business model and the cost of sales, that if they did, for instance, drop in revenue, they would not be paying as much with cost of sales. And if you're interested in signing up to my stockbroker Freetrade, you can actually get a free share if you use the link in the description down below. One of the most impressive parts of this company, or perhaps the value of their stock if you wanted to buy, is actually their dividend. Currently their dividend yield is 1.76%. which obviously is on the lower end of things. But I believe there's a lot of potential for dividend growth in the future. This is because currently they have a payout ratio of 3.5%, which is ridiculously low and great. This means they can reinvest a majority of their earnings back into the business, but also they could rapidly grow this dividend without really impacting how much they're putting back into their business. Whilst their dividend history has been very volatile over the last 10 years, they have still paid a dividend each and every single one of those years. And most recently, they are actually paying a special dividend of 40p for this year, which will be, well, you won't be able to claim it anymore unless you already held shares in January. But this is a 20 times difference compared to 2019's 2p dividend. More recently, they actually provided a trading update. And when I say more recently, I mean literally the day of recording this video, which is the 24th of February. And this had said that their group had recorded a an increased cash balance, which remains in excess of £10 million. Which is interesting to hear because their special dividend and that payout is equivalent to £3.75 million, suggesting to me that they've had very, very strong earnings in this time period, and simply put, their balance sheet is almost back up to where it was. And furthermore, they've upgraded their expectations and said that their previous guidance wasn't good enough and that they believe they will continue to outperform. I usually like to see directors in a company have skin in the game, basically meaning that they own shares of a stock so that they're more motivated to work harder and therefore look for the best interests of shareholders. Well, with best of the best, actually a majority of the entire share pool is held by individual insiders. In fact, a total of 75.2% is held by individual insiders, and the biggest holding is actually 50.37% ownership with a gentleman called William Hindmark, which also suggests it could be a family-run business, as there are multiple people sharing the same surname which have positions in this company, which could be a bad thing for corporate governance. It may be harder to monitor. Shareholders can't necessarily vote him out of the board, and so there could be some conflicts of interest somewhere along there, like we've seen with Boohoo. However, as long as it's kept under a closer eye, I don't think it's that much of a concern. Don't. Very posh. A previous concern that investors had about this business is that they did exercise options so that they could potentially be taken over, which wouldn't have been a good thing. If you believe in this company and then another company comes in and only offers a 10% premium on your investment when you think it could 3 or 4 times in the next 5 years, then that would very much suck. However, at the time, they had only done this as a backup option and not as a preferred way to generate returns. But now recently they've actually dismissed this. They've now decided that it's going to be too distracting and that it's not in the best interest of the shareholders. And so I think this is a very good positive for the future, as they want to focus on the continuing growth of the business under their existing purely online strategy. Initially, when planning this video on Monday, shares had dropped by over 16% in best of the best, and I thought that would be a great value to pick them up, especially as they had had a recent run up. Although since then they have recovered a majority of the way and are only down around 7% now. I still think this is a good buying opportunity. This is a very quality business and their market cap is so small, meaning it's more likely that you will get higher shareholder returns over the long term if they're able to maintain this revenue growth. With a price to earnings ratio of only 28 times, and yet in the last year alone they've doubled their revenue, I think there's a lot of potential for the future, especially as they're transitioning, well, they have transitioned to an online only business model, and they do also have apps, although I believe it's either Android or iPhone, and they're releasing one onto the other platform, but the other one is not done just yet. And because they are an online only business, this means they have the potential to market to international, they could market internationally, build up more customers, but at the same time they could use this and continue growing their revenue streams as much as possible. If you'd have bought this stock in the last 5 years, you would have gotten returns of over 1,100% with dividends reinvested. And I think despite that significant run up, and yeah, sure, it's probably very unlikely to continue that fantastic speed, I do think there is potential for the future. And at such a cheap valuation, as I mentioned, in my opinion, I do think there's potential for valuation multiple growth, but also the likes of earnings growth, as that has been very strong too. And as I said, with the surge of spending, perhaps individuals will look towards online competitions and put money there. Although obviously with the high street stores being shut, for example, this could mean that people might be more inclined to go out and spend in actual shops, and therefore less likely to spend online, but it really depends. But I do really think that the way of our future has definitely changed, or at least advanced in a few years, and more people are buying things online, and online competitions to win a luxury car does seem like quite an appealing thing, or quite an appealing thing to enter. If you're interested in my 10 UK stocks to buy in 2021, then click the card at the top right of the video. Thank you for watching, have a great afternoon.